Hello friends, and I hope the markets are going to treat you very, very well and you're going to have a profitable crackerjack year in this calendar year as well. Well, in the past videos, I have discussed procyclical hysteresis in 2025. That's come out wonderfully well. In 2024, I made videos for you about how bullion is going to outperform markets that we discussed here in these videos, and they've all lived up to our expectations. Equities underperformed bullions just as we expected. Now, in this video, I want to talk to you about what 2026 holds in store for you. Before we proceed, a bit about myself. I'm Vijay. In May this year, it'll be 40 years since I've been trading financial markets on my own book. I run a prop trading small family outfit, and I do not provide any paid services. So all my videos, all my social media output is basically loves labor and my own passion. I'm just trying to help you as a newbie trader or as a doer of deeds to get a bigger bang for your buck in the markets. Now, what really happened in the markets? You all know me for a guy who's very heavily reliant on data and logic, mathematical and statistical trading systems along with behavioral finance. So this video is going to be very heavy on data. Now let's take a look at what really happened. In this calendar year 2025, you saw the bank Nifty go up 17% as against a gain of 5% in 2024. Now that is an improvement. The Nifty 50 itself rose approximately 11% as against the prior calendar year 2024. Now, what does it tell us? Now, very simply, I've told you this in many of my past videos. The bank Nifty and the banking and financial sector by itself are make or break or the swing sector in our financial markets. The reason is what you can see on screen, the weightage itself. Now, the banking and financial sector stocks command a weightage which is the highest in the sectoral metrics, and it commands as much weightages as the next three sectors cumulatively put together. Now, that is what makes this sector so important. Unless the banking and financial sector stocks go up, forget about a sustainable rally, which is why we look at the Bank Nifty so closely. Now, on the other hand, what you saw in the commodity markets is gold. I'm talking of MCX prices here. 5 rose 76%. Silver, well, 170%. Crude oil lost 15% in this calendar year. Natural gas went up 9% in this calendar year. Copper on the MCX went up 62%. Aluminium went up 23%. Lead and underperformed at 3%, and zinc went up 10%. Now, before you kind of go any further, do remember that these are prices compared to 31st December of 2024 vis-a-vis 31st of December 2025. It does not include trading costs, commission, taxes, and other levies. It does not include the cost of carry, which is a rollover that you would have paid. If you include those, I can assure you that many of your commodities would be giving you negative returns, especially zinc, lead, natural gas, of course, because during winter months, there are times when it even commands a cost of carry of 10, 12, 15, and 20%. Crude oil, of course, is negative. I've been telling you there is no super cycle in the energy markets, and there you have it. Now, in the calendar year 2026, what is the outlook for equities? And if at all the market is expected to rise, why? Now, equities are bullish or appear to be bullish in the beginning of 2026. In spite of all the bad news, you have geopolitical issues, war in the Middle East, you have a problem in Eastern Europe, You have simmering tension in Asia where China is basically eyeing Taiwan and the US is trying to ward it off. Why are the markets still going up? If I can mention it in one simple phrase, money flow. There is money flowing into our global financial markets, and which is why prices are going up. Now, where is the money coming from? The rampant effect of the cumulative unbacked currency printing that we have seen, which went into overdrive once COVID based lockdowns were imposed in March 2020. That means there's so much of liquidity sloshing around in the system that it's waiting to get deployed somewhere, and financial markets are a good place that they want to be in. Of course, if money is being pumped into the markets, it wants returns and profits, which is why prices are getting pushed higher. Besides, and this is something that I have discussed in a prior video, world over, governments are deploying pension fund money, retiral savings of its citizens into the stock market. Now, let's start with the biggest boy of them all, the USA. President Donald Trump has basically announced and passed a law saying that US pension money, which is kept in a scheme called Plan 401k, which has a kitty of, hold your breath, $17 trillion. You heard that right, 17 trillion US dollars, which he said will be deployed into riskier assets. Not just government bonds, not just any other scheme, but riskier assets, which means equities, cryptocurrencies, the works. All right. Now, along with the US, who else is stepping on the gas where retiral money of its citizens being deployed in the market is concerned? You have Norway, you have Sweden, you have Australia, amongst many, many other nations that you can think of. A simple Google search will help you do it. Now, these guys are basically going into overdrive, putting citizens' money into stock markets, and therefore markets are rallying in spite of many people rubbing their eyes and saying, hey, what's happening? I can't believe these prices. But as long as money comes in, markets go up. It is also customary in the Middle East to have sovereign wealth funds which are controlled by a very tightly run organizational setup, administrative setup in the government, to have wealth funds that are also investing their petrodollars into riskier assets like equities worldwide. Now, as long as the money keeps coming in, the markets are therefore likely to continue to go up. The other aspect why markets are continuing to go up since the last couple of years and might just continue to go up in 2026 is because corporates are using their equity shares like quasi-currency. They pledge their shares as collateral and they take institutional, especially bank funding against these stocks. Now, which means if the stock price comes down, these corporates will have to pay a haircut or make good the difference by providing more collateral, more number of shares, or maybe even returning a certain amount of money, which is why there is a vested interest in the corporate segment to keep stock prices high. Now, whether it means bullish guidance, cheerful announcements, and periodic analyst guidance in the electronic and the print media, you know the works. So, which is why some of the many reasons that I've given you are at play, and therefore the markets are likely to continue to stay buoyant. Now, you will be wondering as to why commodities, especially gold and silver, went up the way they did in calendar year 2025. And all that you've been hearing about metals and other hard assets being in a super cycle, or at least if not in a super cycle, multiplying in prices over the next few years or maybe a decade or more. Are they actually going through all that is being talked about in the media? Well, like everyone else, you are at a liberty to basically nurse your own hypothesis, and in this video I'm going to share with you my hypothesis. I'm seeing a lack of confidence in fiat currencies, which means paper currencies. Now, paper currencies are the mode with which you make payment for what you buy in the commodities segment. Now, when I start to lose confidence in a paper currency, I'd say, hey, let me spend this money and buy something that is going to be a hedge against inflation or a hedge against devaluation of the currency. What do I buy? I could buy real estate, I could buy gold, I could buy silver, I could buy other metals if I am a businessman that is distributing copper, aluminium, lead, zinc, whatever. I'll go out there and buy hard assets. So which is why demand for these assets is resulting in prices going higher. So lack of confidence in fiat currency is one major reason. A loss of purchasing power of the fiat currency. Remember, so many governments are printing currency like there's no tomorrow. Now, when you have an oversupply of currency, what do you think will happen? It'll basically lose its buying power, which means the price of assets get repriced upwards. Now, the super cycle narrative. Now, let's start with the energy super cycle. You would have heard the super cycle theory ever since the COVID lockdowns of 2021. Well, unfortunately, it's the fifth year for retail oil and gas bulls who've gone and initiated long positions based on this super cycle hype or hope, where they've basically paid mark-to-market losses, they've rolled over charges that they've paid on these long positions and execution cost commissions and taxes. They're really, really underwater. Now, that bleeding apart, is there a super cycle in metals as well? Well, let me allow myself a little bit of a divergence from the public narrative. I do not buy the super cycle theory. I am buying a bull market theory. I'm saying that base metal prices are likely to be bullish. Like I said, lack of buying power of the fiat currency. There is a kind of a rush to hoard these hard assets before currencies devalue even further. So yes, prices can rise significantly, but is it a super cycle? I don't think so. What's the difference? Prices go up in a super cycle, prices go up in a bull market. What's the difference? In a super cycle, they don't correct much. There is a sideways or a time-wise correction. Prices don't really fall very badly and not for extended periods of time. Now, if you remember the narrative of timber, do you remember timber during the COVID lockdowns in 2021? Prices of timber multiplied. What is timber? Chopped wood. You basically chop wood and then throw it into a waterfall. It goes downstream, gets collected by the sawmills, and it's made into furniture. Why did timber prices on the international commodity exchanges multiply? Because a narrative, a hype was built up thanks to the social media. Were trees running away and migrating to Mars? They were not. Were the rivers across the world drying up tomorrow morning? They were not. But hey, crazier stuff happens when a whole lot of narrative and echo chambers come into play. Remember, these are modern electronic markets. This is the electronics and therefore the information age. Along with information comes disinformation. The recent narrative of artificial intelligence triggering a huge amount of demand spike in electricity. I completely agree with that. The electrical demand part, I agree. But there was another attachment to this hypothesis. Natural gas prices would go up because natural gas would be required to generate electricity. Hey, nobody asked these guys, why not coal? Governments in Europe are destroying the COP30 agreements that they signed during COVID, zero emission, net zero, etc. They're going back to coal with a vengeance. Why not nuclear? Why not heavy fuel oil? Why not diesel? Why not burn coke pellets? Why not solar power? Why not hydro, hydel, or other forms of power generation that are available to mankind? Why only natural gas? And if you saw what happened on 5th of December 2025, natural gas went to almost $5.5, collapsed to sub $3.75 in 11 sessions flat. There was a fall of 30%. Now, the classic Dow theory tells us that anything that falls more than 20% is in a bear market. So if the super cycle narrative in gas was to stick, it should not have fallen this much in 11 trading sessions. So it could be a bull market in in natural gas, but not a super cycle. Prices don't fall 30% in 11 days in a super cycle. That's what I'm trying to tell you. I might be willing to agree that it's a bull market in industrial metals, but I don't buy the super cycle theory. Now let's come to another factor that's going to be at play in the international financial markets, the foreign exchange factor. Well, the US dollar index fell 9.4% in calendar 2025. Now, the US dollar is the global reserve currency, still the largest global reserve currency, although it's coming down in its weightage. But the fact remains that the dollar fell, which means as the invoicing currency, it pushed up the prices of hard assets, which is commodities in the international commodities market. The rupee itself fell 5% in calendar 2025 against the US dollar. Now, long period average or LPA, the rupee is known to fall between 3.5% to 5% a year ever since we gained independence in 1947. Now, that is exactly what I meant when I said earlier that global currencies are losing their purchasing power. So look at how the dollar and the rupee both lost in 2025. Now, since a falling currency, domestic currency, triggers imported inflation, India is a net importer. So when you say imported inflation, anything that you import, even if the price has not improved or increased in the international market, the landed price in India will be higher because we have to pay more rupees for that particular commodity. And if you're talking about crude and natural gas, which are hydrocarbon fuels, now oil and gas are something that I call multiplier commodities. When their price goes up, everything from taxi fare, bus fare, transport costs, vegetable, fruits, eggs, milk, all prices get impacted and inflation occurs. So, which is something that we need to watch out for in 2026. Now, why should equities rise in 2026 in spite of weakening fiat currencies? Now, here again, the market has its narrative ready. I'm just repeating it to you. You may choose to believe or not believe, and do remember narratives change with the weather. In the month of end of November and till the first week of December, natural gas was supposed to be in a super cycle because AI servers would demand electricity. And you don't hear about that story anymore. So do understand that stories change very, very rapidly. This is the electronics age. Now, the theory going around about why equities should rise is because when the rupee and the dollar or any other currency in the world is losing its purchasing power, a company that's listed on the stock exchanges, it's an earning entity. It's a profit generating entity. There is an earning per share. Just like you're paying more rupees to buy a gram of gold because the purchasing power of the rupee has gone down, people are arguing that you would have to pay more rupees to buy the stock of a company because it is an earning member of your family once you own it. So, stock prices need to be repriced upwards. Like I said, it's the present day and age hypothesis, could change with the weather. Although inflation is supposed to be negative for equities, but in the last couple of years, we've seen and witnessed how everything that we learned in school and college and high school economics has flown out of the window. So let's be ready for that in 2026 as well. Now let's come to the bond market. Those of you who know me long enough will understand that I assign a great deal of weightage to the fixed income markets because this is the market that is a fountainhood, the source of all money supply for other asset classes. You keep easy and low cost money available, you trigger bull markets all over the world. The minute you turn off the money tap or raise the price of money, which is the interest, asset prices tend to come down. Now, I've been very vociferous about my opinions on my free Telegram channel. That's one platform where I can upload any kind of document, a PDF, a video, a graphic, etc. Unlike other social media platforms which allow mostly only graphics and videos. So a Telegram channel, the link to which is in the graphic, in the description and in the pinned comment below, is where I share most of my thoughts and my data. I've been saying that cost of money, the real effective borrowing cost is going to go up, irrespective of the fact that central bankers could announce a cut in coupon rates. Try going to a bank and ask for a loan and see whether you're getting it at the repo rate plus a percent or two. You're not going to be able to get it. So the cost of money, the real effective cost of money, is going to stay elevated in 2026. I continue to hold my sovereign investments that I have existingly. And like I recommended three fantastic free online books written by my favorite author, Dick Stoken. These books are admittedly of the 1980s and 1990s, not easily available out of print in circulation. You'll only get them online as free downloads. This is the gold standard on cost of money concept. I haven't seen any other author go into detail like this. All right. So the cost of funds theory itself tells us that we should basically keep the powder dry. At least that's what I'm going to do in 2026. I'm not going to make fresh deployment into the bond market or into sovereign guaranteed investments unless and until the yields go up. Am I expecting yields to go up in spite of the fact that media reports are talking about small savings scheme interest rates, particularly starting with the Public Provident Fund or the PPF, like the Economic Times suggested some days ago, might be revised downwards to even sub 7%? Yes, I think there will be better opportunities elsewhere, which is why I said I'm going to keep the powder dry. Now, if the cost of money is going to remain elevated in 2026, so will be statistical beta, which is pure price volatility of high risk assets, that is equity, currency, and to a certain extent, even commodities. So get set, be ready for high volatility, familiarize yourself with Dick Stoken's work, and also risk mitigation in the financial markets. Now, how does it matter to you as a retail trader? Whether you borrow money or not from a bank is besides the point. Now, one way to look at it, and I've been sharing a whole lot of data with you on this, is the margin funded trading of the retail guy. Of late, what we have seen is that retail guys are going out there and buying stocks with money that they borrow from the broker. It's called the MTF, or the margin funded trading system. It's very simple. You pay 30% down payment to the value of the stock. The broker funds you 70% of the remaining amount. The stocks lie with the broker as collateral. He charges you interest on that 70%. Now here is a problem. It's not as simple as you think it is. If the price of the share goes down, your contribution of 30% also reduces. Now you'll have to pay extra money so that you come back up to even at 30%, or you give more fresh collateral. All right. And this interest is anything between 12% to 17, maybe even some cases 18%. So when you are borrowing money to buy stocks, instead of just the price, you're taking on two adversaries: the price, which can go against you, and time. Even if the price doesn't go against you, your interest clock, your interest meter is ticking. So if you suffer a loss in price, the interest cost will add to your losses and give you a bigger jolt. Now, this margin funded trading has basically gone up significantly in calendar year 2025. Now, there are two ways to look at it: the number of shares that retail has bought with borrowed money, and the absolute value of the shares of which they have bought with funded money. Now, if you're talking about number of shares, it's gone up by 54%. And in terms of absolute amount that they have borrowed, the value of the shares that they have been purchased with borrowed money, they have gone up by 37.5%. Now, why is there a difference? Why is it that the number of shares borrowed is 54% and the value of the shares that have been borrowed with this margin funded trading is 37.5%? Simple. The value of the shares has fallen after the retail guy, the average Joe, has bought it with broker funding. He's suffering a loss. It's just the price. It's just the price. Interest is extra. So you see, he's underwater. Now the charts on your screen that I have been flashing about margin funded trading while I was narrating this theory to you tells you that the margin funded trading amounts in rupees and in number of shares may have gone up, but the market capitalization has not gone up to justify taking such a big risk. Is this going to be a very comfortable situation in 2026? Hey, no. Which is why I expect higher volatility. The retail is heavily leveraged. And I'm not even including futures and options. That's also buying with borrowed money. And there's rollover costs, there's execution costs, commissions and taxes. Loan against shares. People pledge loan against their shares with the bank and take a loan. Now, under the new guidelines, it's allowed up to 1 crore. Loan against mutual funds. People are pledging their mutual funds with their banks, taking a loan and buying more stocks. Now, this is nothing but multi-level marketing at play. So, we are not even talking about these. We are close to 1,12,000 crores in margin funded trading as on end of December 2025 as I record this video. Now, how much has this gone up? Just to put you in perspective, over the 20-month period, the number of shares bought with margin funded trading amounts is 45% up, and over 30 months, that is 2.5 years, it is up a whopping 170%. This is the amount of borrowing that the retail has resorted to buy shares, and they are paying interest on it. The prices better go up, or many of these guys are going to be underwater. Your entry and exit had better be laser precise and super sharp, or you're going to be very, very sorry about it. Now, let's discuss the strategies in various asset classes. In equities, I would basically do a very simple thing. Let me narrate a small story to you. Napoleon wanted to compete with the British in terms of dominating the world. So both were maritime nations, both France and England had very big navies. So Napoleon would take out armadas of ships and go out there and conquer new lands, discover new lands and conquer them. He would call his generals and ask them, I want to go out there for a naval conquest expedition. I want to take my generals with me. Are you going to be lucky for me? Now, some guys would say, look, we are warriors. We don't understand what luck is. So I don't know whether I'm going to be lucky for you. You decide. The Emperor Napoleon would tell them, step aside, please. There were other kinds of guys who would say, yes, Your Excellency, I just consulted my astrologer today morning. I matched my horoscope with yours and he says I'm extremely lucky for you. Napoleon would tell him, step aside, please. Now, the third kind of guy, he's a general who's a sharpie, super savvy. You say, Your Excellency, I don't believe in luck. All I know is that you're taking out this expedition to discover new land so you can conquer and plunder them. I will ensure as a general that your soldiers under my command are willing to fight to their death so that you can win the war. And it will facilitate you robbing the country. As a side benefit, I will rob a few villages. And I hope you don't mind, which is why I will be lucky for you if you take me. Hey, guess what? Napoleon used to take the third kind of general. Because as per behavioral finance, the most reliable interest in the world is vested interest. As long as somebody has a vested interest in what you're doing, they will always be loyal to you. So I'm going to have Napoleon's theory at work. I'm going to do what Big Brother, that is the government of India, is doing. If they decide by way of policy that public sector units or public sector undertaking stocks need to go up because they're going to be disinvested, hey, I'm going to buy those stocks. Okay. There is a video that I made a couple of years ago, why I like playing with PSU stocks. Watch this video, please. It's an eye-opener. I could make a two-way trade. both ways, buy and sell. There are merits in these stocks because of the reasons that I've explained in this video. I will play with banks in 2025, both directions, long and short. Why? Because of the weightage. I explained to you their weightage is so high that they are quite simply the biggest swing sector in the market. There can be no sustainable rally in this year unless banking stocks participate. Now, on the flip side, if the position building is too aggressive, too much, too fast, I'll keep a wary eye for signs of exhaustion that can also trigger a crowded exit. That can happen in 2026 at least once, if not more. Do remember the leverage is extremely high at this point in time. So, in order to mitigate some of these risks, like I said in this video, I will deploy a twin tracking strategy of long and short tail distribution. This is a statistical concept that's explained in this video. And unfortunately, this strategy is capital intensive and therefore for deep pocketed high net worth traders. So you can consider deploying this strategy, failing which you can also deploy the Hacienda hedge or the tail risk hedge strategy, which is explained in this video. Now for my strategy in bullion. I've been bullish on bullion since many years. You've basically seen these videos where I explain to you why bullion needs to go up. I've also explained in great detail, like nobody else has, as to how you can buy bullion, check its purity, buy at the best possible rates from Zaveri Bazaar in your city, get purity checked, and negotiate a buyback when you want to sell. Right? Watch these 2 or 3 videos. The link is there in the description and the pinned comment below. Also, I've written about bullion since many years in my media columns and in Equity Masters YouTube channel right since 2019. You can find those videos there. Now, what's happening? I've told you about the target of gold at 1 lakh, done. I've told you about a target of 1,50,000 in silver, done. More than done, all right? So those of you who've been following my advice on gold and silver have seen prices of gold more than double and prices of silver go up more than 3.5 times, all right? Now, what do we do from here? Now, it all depends on what you're looking at. If you're a short-term trader, I don't know how to help you. I'll be very honest with you, I don't know what's happening in the absolute near term. All I can tell you that I see the waters are very, very muddied. Excessive speculation, excessive leverage, margin-funded trading, buying in futures and options excessively is creating a whole lot of volatility. So the short-term outlook is muddied. It's unclear, it's foggy. I don't know what to do. But you give me time. Give me a couple of years and I know I'm very comfortable holding bullion that I have. I'm sitting on it. I'm in no hurry to sell. Why? Because we are going to debauch our fiat currency. We are going to brutalize our fiat currencies even further. Inflation, especially food inflation worldwide, is going to go up higher over a period of the coming number of years. Bullion will be your best bet over a long period of time. You'll have to look beyond 2026 or even further. If you're trying to get rich quick within a week or something, I'm sorry, I don't have any magic wand. I'm completely clueless. Over a longer period of time, stick with it, be patient, do not leverage, don't suffer the temptation and borrow money to buy bullion. Buy whatever little that your own pocket justifies you buying it. Hold all that you have currently that you bought at earlier levels after watching my earlier videos and reading my articles. Don't sell in a hurry. But should you buy now at the present levels? I don't think you should be buying at these present levels when silver is trading at 2,40,000 rupees a kilogram or gold is trading at 1,35,000 rupees for 10 grams on the Indian exchanges. I would not suggest buying now. Now I come to my strategy on bonds. Now sovereign investments, like I said, they remain my backbone. I would continue to keep the powder dry, waiting for better yields. Now let's start to sum up what we've spoken and seen in this video. The strengths of the Indian market are the inflows remain robust because retail buying is coming in from the average Joe and pension fund money, including in India, not just abroad. You are basically seeing the National Pension Scheme, the EPFO, etc., also participating in the equity markets, which is why inflows continue to be seen inside. The second point which works in India's favor is that if at all there are fears about a crash in AI stocks, India is relatively speaking an AI crash proof market. We did not participate in the AI based rally, so we are not going to suffer when AI crash comes. Now, deficits and balance of payment situation in India is much better than other emerging market destinations, which is why we are relatively better poised. Are there some weaknesses in the Indian markets that you need to look at in 2026? Yeah, sure. If the rupee weakens further, it'll basically trigger even higher imported inflation. I'm looking at concerns in the microfinance sector, small loans, credit card debt, household debt rising in India, and unemployment remaining sticky. Now, cost of funds, which is of paramount importance to me because like I'm being a student of Dick's token, I think it determines the asset prices across asset classes. The cost of funds, I suspect, is going to remain elevated in spite of the headline coupon rates. Now, geopolitical and trade tariffs are unsolved at the time of making this video. They need immediate resolution, failing which the volatility can continue to remain where it is right now. Now, we've had some internal social disturbances and they have the potential to impact sentiments for and against India. The other aspect is welfare spending is rising exponentially, and the cash support that the government is giving to certain segments of the population are creating a burden on the economy. Now, these are things that I will be looking out for. And of course, what we've seen is that pension funds, especially in Sweden and Norway to a very great extent, have seen crippling losses because stock prices have come down in Europe. So a pension fund money going into equities is a good and bad. As long as the going is good, nobody's complaining. But when the markets turn turtle and they go south, remember what happened to people who bought ULIPs in the global financial crisis of 2008. Many Indian investors learned the hard way that buying insurance, which is ULIP in simple terms, they saw their NAVs of their money or their insurance policy go down substantially. Of course, if you waited it out, it evened out over a period of years, but the heartburn and stress that it created while the prices were down is not funny. Now, what will I watch carefully in calendar year 2026? Indian 10-year sovereign bond yields, if they cross the band of 6.9 to 7%, I will sit up in my chair and start looking at it immediately and probably redraw my trading blueprint. If the USD INR, which is the rupee versus the United States dollar, crosses 93.5, I'll immediately sit up in my chair and start tweaking my trading strategy. Inflation, particularly food inflation, and monsoons starting from end of April, I'll start monitoring news about the monsoon. If the bank nifty weakens, I would basically sit up in my chair and start looking at redrawing my blueprint. Remember, it is more than 1/3, banking and financial sector is more than 1/3 of the weightage in the entire market. So if that starts to drag the market down, the market won't be able to keep steady for too long. Now, those are my pressure points. If the margin funded trading crosses, which is currently 1,12,000 crores, if it crosses 1,40,000 to 1,50,000 crores, which is 1.5 trillion rupees, I'll start to look up and say, hey, I'm feeling a little sweaty under the collar. I'm not comfortable here. Now, for F&O traders, particularly, I think our capital intensity, which means the amount of money that we need to stay in the business and conduct our business, will go up because margins are being made stringent and margin percentages are raised. As volatility goes up, you're going to have ELMs, which is extreme loss margins, concentration margins, and ad hoc margins go up. Do remember, if the market is going up, the capitalization of the contract is going up, and therefore the margin will also go up. You'll need more money to make money. Now, option writing, which is theta decay, your return on investment will compress probably. A high degree of probability will be compressed because of arbitrage created by competitors. Today, for example, it's a hypothetical number. If you're happy writing options for a yield of 2%, there could be one guy who's saying, okay, I'm okay with 1.95. There could be somebody else who says, okay, 1.9 is fine with me. The third guy says 1.85. Now 1.85 becomes the threshold. There are times, a couple of scattered trades, when I've taken theta decay trades of 1.15% a month. That's low, considering, and I'm talking gross. The execution cost commission tax is beyond that. All right. So I am expecting A, the capital requirement to go up, and B, return on investment come down in 2026. Brace up is going to happen. Volatility risk will rise substantially in 2026, which means failure rates for retail traders will also rise substantially. Now, when the retail fails, they exit their positions with knee-jerk and emotional fashion. That means there is a feedback loop. The more the retail guys fail and get out, the more volatility they create because they sell at haphazard prices. Now, volatility risk is extremely high in 2026. I'm seeing standard deviation readings on my statistical trading models go up slowly but steadily since the beginning of 2025. This is going to be a specialist market. This is going to be a market for extremely cool-headed, systematic, and extremely logical and hard-nosed traders. I think the guy who has basically learned the art of discipline and keeping emotions under check, has the fortitude, has deeper pockets, and a trading blueprint, will do extremely well in 2026. I hope my video has clarified things to you to a very large extent. And before I sign out from this video, reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment segment, do let me know how my videos help you improve your trading experience in the markets. And do share my videos with your family and friends to help others to basically learn the art of information-based, knowledge-based trading and investment strategies. I thank you for your patience in being with me in this video. I also wish you a very, very profitable year 2026 ahead. Take care. Bye-bye.